Margaret is 74, retired school teacher, 38 years, Barrie, Ontario. Lost her husband 4 years ago. Last spring, her credit union finally offered her a decent rate, 4.25%. So she moved her life savings, $152,000, into a GIC. She never touched a penny of it, never even withdrew the interest. This spring, Margaret opened her notice of assessment and found something she'd never seen before, a smaller OAS deposit and a line she didn't recognize, recovery tax. The year before, her OAS came in full, same CPP check, same quiet life. The only thing that changed was where her savings sat. Here's what nobody told Margaret. There is a line. $95,323 of what the CRA calls net world income. And once your GIC interest pushes you over it, that interest gets taxed twice. Once as regular income, and again because every dollar over the line claws back 15 cents of your own old age security with it. The law says nobody has to tell you, not the bank, not Service Canada, not the CRA. You have to know the line. And in this video, I'll show you how to find yours to the dollar. In the next few minutes, I'm going to show you 3 things. First, the kinds of income the CRA counts against you that almost nobody expects, including interest you never touched, and one kind of withdrawal that's supposed to be invisible. Second, later in this video, I'm going to show you the one filing mistake that quietly doubles a couple's exposure. If you're married, you especially cannot miss it. And third, at the very end, the exact sentence to say to your bank, word for word, and the one government form that makes sure next July never ambushes you again. Nothing here needs a lawyer, an advisor, or a fee. Just knowledge and one phone call. Right now, you may be thinking one of 4 things. Let me save you the trouble. 1. I'm not rich. This isn't me. The threshold is $95,323, and it's individual, not household. CPP plus a modest workplace pension plus OAS itself gets you a long way there before your savings earn a dime. 2. My bank would have told me. The bank did tell someone, the CRA. It's called a T5 slip, and it reports your interest automatically every year. Telling you what that does to your OAS is nobody's job, so nobody does it. 3. I heard the government raise the OAS clawback threshold, so I'm fine. They did raise it, a little, for inflation. But raising a line by a few $100s doesn't help you if your GIC just handed you $6,000. 4. Too late. I already bought the GICs. It is not too late. There are 2 fixes that still work this year, and they're both in this video. And if you think this doesn't add up to much, consider this. The recovery tax was designed decades ago to touch only the wealthiest retirees. Today, rising GIC rates, mandatory RRIF withdrawals, and years of frozen or slow-moving thresholds mean ordinary savers, people who did everything right, are getting pulled across a line they never knew existed. That drift wasn't an accident. Stay with me and I'll show you the machine that did it. Write this down because here's the whole machine, and it's 3 lines long. The CRA calls it net world income. Line 1, your other income, CPP, workplace pension, RRIF, or RRSP withdrawals. And yes, every dollar of GIC or savings account interest. Line 2, your OAS payments themselves. Write that down and circle it. The benefit you're trying to protect, it counts toward its own threshold. The CRA adds your OAS right back into the pile that determines whether you keep it. Line 3, if you hold dividend-paying stocks, the grossed-up amount, not the cash you actually received. Canadian eligible dividends get inflated on paper by roughly 38% TEWS, before the CRA counts them as income. You might collect $5,000 in dividends and watch $6,900 show up on your return. On this test, the phantom amount counts. Add those 3 lines. If the total passes $95,323, the CRA starts clawing back 15 cents of your OAS for every dollar over, cross roughly $154,700, age 65 to 74, and your entire OAS is gone for the year. Now let me show you what this does with real numbers. Gerald, 71, retired plant supervisor, Cambridge, Ontario. Workplace pension, $70,000. CPP, $15,000. OAS, $8,908. Add those, $93,908. Already sitting almost exactly at the line before his savings earn a cent. Last year, Gerald moved $150,000 out of a checking account, paying almost nothing into a GIC ladder at 4.25%. That's $6,375 of interest. New total, $100,283, $4,960 over the threshold. Here's where it hits twice. First, that $6,375 gets taxed as ordinary income. At his marginal rate, call it 30%, roughly $1,912. Second, the $4,960 he's now over the threshold triggers a 15% OAS recovery tax, about $744. Combined hit, $2,656 on $6,375 of interest. That's an effective rate of about 42%. His GIC earned 4.25%. The government's cut coming and going was nearly half of it. And here's the trap inside the trap. This applies whether Gerald touched a dollar of that interest or not. On most cashable and short-term GICs, interest is credited and reported to the CRA on a T5 OAS every single year, whether he reinvests it, withdraws it, or lets it sit. The money never moved. The tax bill did. So how much is too much to keep in a GIC or savings account? Here's your personal line, and it's one subtraction. Take $95,323. Subtract your CPP. Subtract your OAS. Subtract any pension or RRIF income. Whatever's left is your room. Divide that by your interest rate. At 4.25%, every $23,500 of savings throws off exactly $1,000 of counted income. If you've got $10,000 of room, your safe ceiling is somewhere around $235,000. If you've got no room left, every new GIC dollar may be earning you 40 cents on the dollar against yourself. Thinking your numbers are smaller than Gerald's and this doesn't apply to you? Don't go anywhere. The next part is about the people this rule hits hardest, and it might be you. Quick checklist. You're in the crosshairs if you're a widow or widower now filing as an individual, and your late spouse's pension income no longer offsets yours, so your own net income climbed on its own. You took your first mandatory RRIF withdrawal this year. RRIFs don't ask permission. They force a minimum out every year, whether you need the cash or not. You finally moved money out of a checking account into a GIC that actually pays. Or you hold dividend-paying stocks and didn't know the CRA counts more than what actually landed in your account. Any one of those can shove you over a line you never knew existed. 3 myths keep people from looking. Myth 1, shame. If I owe recovery tax, I must have filed something wrong. You filed fine. The threshold moves a little each year with inflation, but GIC rates and mandatory RRIF withdrawals have moved faster. Not your guilt, not your math. Myth 2, fear. If I move my savings, the CRA will flag me. Moving your own insured deposits between institutions is generally not a taxable event and not a red flag. It's your money. They hold it. You direct it. Myth 3, pride. I've done my own taxes for decades. I'd have seen it. The OAS recovery tax calculation lives on a T1-OAS worksheet. Most software fills in silently, with no explanation of why your refund shrank or your OAS deposit dropped. It was not written to be seen. It was written to be correct. Quick case. Helen, 76, widowed, Kelowna. Her advisor put her into a portfolio of Canadian dividend-paying blue chips. Tax efficient, she was told. Helen collects $8,000 a year in eligible dividends. On the CRA's net income line, that's not $8,000. It's grossed up to roughly $11,040. That gross up alone pushed about $2,000 of extra income onto her return that she never actually received in cash, and it was enough to trigger a real OAS clawback. The brochure called it tax efficient. The brochure never mentioned the gross up. The brochure was never going to mention the gross up. Now, the couple's trap, and if you're married or common law, do not file anything until you hear this. Everything so far assumed your own income, on your own return, but the OAS clawback is calculated per individual, not per household. Here's where couples get hurt without realizing it. If all the GICs, all the savings, all the non-registered investments sit in the higher income spouse's name, often just because that's how the account was opened decades ago, every dollar of interest lands on the one return most likely to already be near the threshold. Meanwhile, the lower income spouse sitting comfortably under $95,323 has room going completely unused. Nobody broke a law here. Nobody has to. One old joint decision about whose name goes on the GIC application can cost a couple thousands more in clawback than it needed to, year after year. If you've never checked whose SIN is attached to your household savings, that's the first thing to look at before you touch anything else. Still with me? Good, because knowing the machine is worth nothing until you run your own numbers. That's the next 5 minutes. 3 steps tonight. Step 1. Pull last year's notice of assessment and every T5 your bank or credit union sent you. Add the 3 lines, CPP plus pension plus interest, your OAS, and any grossed up dividends. Compare it to $95,323. Now you know exactly where you stand, which is more than anyone was ever going to tell you. Step 2. Call your bank or credit union. Ask for every account under your SIN, every GIC maturity date, and the exact interest they'll report this year. Here's the stakes line. Every GIC that auto-renews without you checking is a vote to repeat this year's clawback next year. Check first, renew second. Step 3. Pick your shield. If you know you'll owe recovery tax, you can ask Service Canada to increase voluntary tax withheld at source on your OAS and CPP, so next spring stops being an ambush. And if dividend-paying investments or GICs are sitting in the higher income spouse's name for no real reason, ask about spousal loans or simply reallocating new savings into the lower income spouse's account going forward, legitimately splitting future interest so it doesn't all land on one return. If the T5s or the worksheet feel like a wall, ask a son, daughter, or grandkid to sit with you for 15 minutes. It might be worth a few $100s a year. Now, the exact words. Pen and paper out. Call 1, your bank or credit union. The number is on the back of your card or the top of your statement. Call mid-morning, Tuesday through Thursday, when the lines are shortest. Line 1. Force the full picture. Please read me every account under my SIN and the exact amount of interest you will report to the CRA on a T5 this year, including GICs that haven't matured yet. Line 2. The strategy sentence. On any GIC with a term of 1 year or less, I want to understand exactly when the interest is credited, so I can choose which tax year it lands in. Line 3. Looking backward. If I overpaid or missed a deduction in a prior year, I understand I can ask the CRA to adjust a past return. Can you send me a full interest summary for the last 3 years? The CRA generally allows adjustment requests going back several years. That's your money, and nobody is coming to claim it for you unless you ask. If the rep says, I can't see that, or that's not something we do, don't argue. Say, then please transfer me to someone who can or mail me my account summary. I'll hold. Call 2. Service Canada, if you want more tax withheld from CPP or OAS at source, so April stops being a surprise. Call 1-800-277-9914. Best time first thing in the morning, midweek, late in the month. One rule for both calls. If an answer feels off, hang up politely, call again. 2 matching answers, then proceed. 3 mistakes to never make again. 1. Letting GICs auto-renew blind. Every blind renewal reorders next year's clawback. 2. Assuming dividend-paying stocks are automatically tax-smart in retirement without checking the gross-up. 3. Leaving all household savings in one spouse's name out of habit, not decision. Remember Margaret? Here's the ending I didn't tell you. Last year's reduced OAS deposit, gone. It was legally correct and no phone call brings it back. That's the honest part. But this year, Margaret sat down with her granddaughter and ran the 3-line math. She called her credit union and split her next GIC renewal between her account and a smaller one she'd never used. She asked Service Canada to adjust her withholding, so next July holds no surprise. Same bank, same savings, same CPP. The difference wasn't luck or a lawyer. It was 15 minutes of knowing what to ask. Tonight, the notice of assessment, the T5s, 3 lines of arithmetic. That's it. Then send this to one person you know with a GIC and an OAS deposit. A widowed sister, an old co-worker, the neighbor who just bragged about his new rate. You won't be sending a video. You'll be handing them a few $100s a year, every year.